Hello traders, you are welcome back to the Forex Geek channel, and I am happy to have you here. In the meantime, we are going to be discussing an easy 5-minute trading strategy for beginners. The indicators we are going to be using are the stochastic oscillator, and we are also going to be using a double EMA setup. Okay, this strategy is designed to be simple, clear, and quick to apply, so you can identify trade opportunities without overcomplicating your chart. But first of all, we need to set up our chart, right? um, Let us start by adding the necessary indicators that we need. And like I already said, we are going to be using a double EMA setup. So we have to add the 50 EMA first, the 50 exponential moving average. And then we are also going to add the 200 exponential moving average. Ensure to use different colors so that you do not mistake one for another. All right, so we are using the 50 EMA and the 200 EMA. So basically, the 50 EMA will help us identify short-term trend direction, while the 200 EMA gives us the bigger picture trend. Okay, then the next indicator we are going to be adding to our chart is the stochastic oscillator. All right, and the settings we are going to be using is the 14 for percentage K period. Slowing will be 3, percentage D will be 3. Okay, we can just leave the rest of this the way it is. Okay, so this is our stochastic oscillator. You keep the overbought level at 80 and you keep the oversold level at 20. Okay, these will help us to find potential pullback entries when the market temporarily moves against the trend. Okay, now the next step is to understand how the strategy works. And here is the basic rule. Okay, we only take buy trades when the 50 EMA is above the 200 EMA. That is the basic rule. Okay, that means the trend is up. When you find that the 50 EMA is above the 200 EMA, all right, consistently, you can see that means that the trend is bullish. Can you see the trend has been bullish? So during such a bullish setup, we are only interested in buy trades. Okay, we are only interested in buy opportunities. Now for sell trades, it occurs, or rather we look for sell opportunities when the 50 EMA is below the 200 EMA, meaning that the trend is down. So when you have the 50 EMA below the 200 EMA, then you will be looking for sell opportunities. Okay, when the trend is up, we wait for the stochastic oscillator to drop into the oversold zone, which is below 20, then cross back up. All right, so that is our signal that price may be ready to continue the trend. Okay, so in such a scenario, when you have an uptrend, remember that for our uptrend, we must have the 50 EMA above the 200. Then when you have the stochastic oscillator drop into the oversold region and cuts upwards, you should start looking for buy opportunities. Okay, in that case, you should start looking for buy opportunities. Then the reverse is the case for sell opportunities. That is when you have a downtrend, which is when the 50 EMA is below the 200 EMA. Then you just have to wait for the stochastic oscillator to rise into the overbought territory and start crossing downwards. Then you have to ensure that the 50 EMA is still below the 200 EMA. Okay, and make sure you get confirmation candlestick pattern. All right. For the confirmation candlestick patterns, it applies to both the bullish moves and the bearish moves. So when you have a bullish, let's just use practical examples. When you have 50 EMA above the 200 and then you have the stochastic drop into the minus 20 level and start crossing upwards, the next thing for you to do is to look for a bullish candlestick pattern. Now in this case, if you look closely, you will see that we had, okay, where is that example now? As I zoomed in, I am not sure of the particular example again. Okay, so let's just use this, okay, just to save time. So in this particular case, you can see we had a pin bar and we also had an engulfing that swallowed up the body of that bearish candle. So now this could be our confirmation candlestick, right? Remember that this is already a bullish move because 50 EMA is above 200 EMA, and here we already have the RSI, sorry, the stochastic. Here we already have the stochastic oscillator drop below the 20 level. So we already had our indicator confirmation. Then the final confirmation was our candlestick, right? And we got the confirmation around here. So this would have been a good place to enter a buy trade. Your stop loss can be just below that candlestick pattern, and your take profit can be when the indicator entered the overbought territory, or maybe when you have a bearish candlestick pattern form around the resistance zone. All right, now the reverse is the case for a sell trade. Obviously, in a sell trade, you have to wait for price to you have to wait for the 50 EMA to go below the 200, and then stochastic goes up and starts coming down, and then you get a bearish candlestick pattern. In this case, we had a bearish engulfing. Can you see that? You can see we had a bearish engulfing around here. This bearish candle swallowed up the bullish candle. So this would have been a good opportunity to enter a sell trade. Stop loss can be right above that candlestick pattern, and your take profit can be around maybe support zones, or maybe when the stochastic oscillator enters oversold territory. All right. So it's very easy. This combination works well because the double EMA filters out bad trades by keeping you on the right side of the trend, while the stochastic helps time your entries during pullbacks. Okay, so once you see a stochastic signal in line with the trend, you just enter on the close of the candle, that confirmation candle, like we mentioned, after the crossover, must have already happened, right? So remember that you can also decide to use good fixed risk to reward ratios, like maybe 1:2, but always make sure that you set realistic targets. Okay, if you enter a buy trade, you don't want to go and set a target that is beyond a key resistance zone. If you have a key resistance zone around here and you entered maybe somewhere around here, I would recommend that your take profit does not go beyond this place, just in case of if this resistance prevents price from going further. All right, but make sure that your risk to reward ratio is not below 1:2. Remember that this works best when the market is trending strongly. So avoid choppy or sideways markets because the EMAs will be flat and the stochastic will give too many false signals. Okay, so keep it simple and stick to the rules. The double EMA keeps you aligned with the trend, and the stochastic helps you find precise pullback entries. If you found this video helpful, click the like button and subscribe for more beginner-friendly trading strategies. And if you try this method, feel free to share your experience in the comments so we can, learn how it worked for you. Thank you for watching, and I look forward to seeing you in the next video.